In the 1970s, the world's most powerful governments discovered something terrifying. They were losing control. Inflation was rising, unemployment was rising, growth was slowing. The old economic playbook, the one trusted for decades, stopped working. Policymakers had been told they could manage the economy like a dashboard. Push spending up, unemployment falls, cool demand, inflation drops. It felt scientific, predictable, controllable, and then it failed. Welcome to the Financial Historian Files, where money, power, and history collide. And nothing is ever as simple as it looks. When the system broke, one economist didn't look surprised. He had been warning for years that governments were playing a dangerous game. That inflation wasn't a side effect. It was a signal that unemployment couldn't be permanently engineered lower. That attempts to fine-tune a complex economy would end in instability. His name was Milton Friedman. And whether you agree with him or not, the financial system we live inside today still runs on the operating system he helped install. But to understand why Friedman mattered, you have to understand the world he was challenging. After the Great Depression of the 1930s, faith in free markets collapsed. Banks failed. Unemployment in the United States surged above 20%. Output cratered. The old laissez-faire orthodoxy, the belief that markets self-correct quickly, looked naive at best and cruel at worst. Into that vacuum stepped John Maynard Keynes. Keynes argued that markets could get stuck in prolonged slumps. Demand could collapse and stay collapsed. In those moments, government spending wasn't distortion. It was rescue. Run deficits during downturns, stimulate demand, smooth the business cycle. After World War II, this framework became doctrine across the Western world. Governments would manage demand, central banks would support growth, fiscal policy and monetary policy would work in coordination. Regulation would prevent another 1929, and for a time it seemed to work. The 1950s and 1960s delivered strong growth across the United States and Western Europe. Wages rose, industrial production expanded, the middle class grew, inflation remained moderate, unemployment remained relatively low. It felt like a golden era of managed capitalism. Embedded in this consensus was a powerful idea known as the Phillips Curve. Based on historical data, economists observed an apparent trade-off between inflation and unemployment. When unemployment was low, inflation tended to be higher. When unemployment was high, inflation fell. The implication was intoxicating. If policymakers were willing to tolerate slightly higher inflation, they could permanently keep unemployment lower. It was a menu of options. Choose your preferred balance. The economy became something to optimize, and optimization is seductive. Nothing says we've mastered the system like believing you can calibrate it with small adjustments, but Friedman saw a flaw in this logic. In the late 1950s and 1960s, while the consensus was strong, he began arguing that the Phillips Curve trade-off was temporary. Workers and businesses would adjust their expectations. If policymakers pushed inflation higher to reduce unemployment, people would eventually anticipate that inflation. Wages would rise. Prices would rise. The short-term benefit would disappear. You could not fool an economy forever. He formalized this in what became known as the expectations-augmented Phillips curve. In simple terms, unemployment gravitates toward a natural rate determined by real factors: demographics, technology, labor market structure. Attempts to push unemployment permanently below that natural rate through monetary expansion would only generate accelerating inflation. It was a quiet revolution in thinking, and it was grounded in a broader thesis that would define Friedman's legacy. Inflation, he argued, is always and everywhere a monetary phenomenon. That sentence sounds abstract. It isn't. Strip it down and it means sustained inflation happens when the money supply grows faster than the economy's productive capacity. Too much money chasing, too few goods. Not greedy corporations, not unions, not mysterious forces. Money growth. In the 1960s, this was not the dominant view. Policymakers focused on demand management, fiscal stimulus, and fine-tuning. Monetary policy was often reactive and discretionary. Central bankers responded to political pressure. Money supply growth fluctuated. Friedman believed this discretion was the problem. He argued that economic instability wasn't a failure of markets, it was a failure of policy. Governments were oversteering. They reacted late, they overcorrected, they injected liquidity when it was politically convenient and withdrew it when inflation became embarrassing. Instead of discretionary tinkering, Friedman advocated rules. Central banks, he proposed, should follow a predictable path of money supply growth. No improvisation, no political manipulation, stability through constraint. Markets, in his view, were coordination mechanisms. Millions of decentralized decisions guided by prices allocate resources more efficiently than bureaucratic planning. Government intervention, unless narrowly targeted, distorted signals and created unintended consequences. This wasn't a moral sermon. It was an argument about incentives. Bureaucrats respond to political incentives. Markets respond to price incentives. One adjusts through elections. The other adjusts through profit and loss. The difference matters. Throughout the 1960s, Friedman's warnings were intellectually provocative but politically marginal. The post-war order was working, inflation was manageable. In 1973, the first oil shock hit after the Arab-Israeli War. Oil prices surged, energy costs rippled through industrial economies. Inflation accelerated, growth slowed, unemployment rose. Then it happened again in 1979. By 1980, U.S. inflation peaked above 13%. At the same time, unemployment climbed and economic growth stagnated. The term stagflation entered the vocabulary. Stagnation plus inflation. Under the traditional Phillips Curve framework, this combination wasn't supposed to occur. Inflation and unemployment were meant to move in opposite directions. Instead, they moved together. Policymakers had attempted to maintain low unemployment through expansionary policies in the late 1960s and early 1970s. The result, Friedman argued, was predictable. Inflation expectations adjusted. Wage demands incorporated anticipated price increases. Businesses raised prices to protect margins. The temporary boost to employment vanished, but inflation remained. The machine wasn't broken, the model was. This was Friedman's moment. In 1979, Paul Volcker became chairman of the Federal Reserve. Convinced that inflation was fundamentally a monetary problem, Volcker shifted strategy. The Fed sharply tightened monetary policy. The federal funds rate eventually approached 20%. The result was brutal: a deep recession, rising unemployment, business failures, farmers protesting high interest rates, politicians under immense pressure. But inflation collapsed. From above 13% in 1980, U.S. inflation fell dramatically over the next few years. By the mid-1980s, it was under control. The cost was severe. The signal was unmistakable. Monetary discipline worked, at least in controlling inflation. Friedman's ideas moved from academic debate to policy framework. Monetarism, the emphasis on controlling money supply growth, became central to central banking philosophy. This wasn't just a technical adjustment, it was a shift in intellectual gravity. If inflation was primarily monetary, then governments could not permanently engineer prosperity through demand manipulation. If unemployment gravitates toward a natural rate, then policy activism has limits. If markets coordinate better than bureaucracies, then intervention should be the exception, not the norm. The burden of proof shifted. Before Friedman, intervention was the default, and markets were suspect. After Friedman, markets were the baseline, and intervention had to justify itself. That shift did not end in the 1970s. It accelerated. In the United Kingdom, Margaret Thatcher pursued deregulation, privatization of state-owned industries, and labor market reform. Their rhetoric was not identical to Friedman's academic writing, but the intellectual atmosphere had changed. Government intervention was no longer assumed wise. Markets were no longer assumed fragile. They were assumed capable. This is where the phrase trickle-down economics enters the conversation. It wasn't a term Friedman coined. The logic was straightforward. Lower marginal tax rates increase incentives to invest and work. Businesses retain more capital. Investment rises. Growth accelerates. Over time, benefits diffuse through employment and wages. In the early 1980s, the top marginal federal income tax rate in the United States fell from 70% to 28% over the decade. Capital gains taxes were reduced. Corporate tax structures shifted. Financial markets were liberalized. Growth did return after the early 1980s recession. Inflation stabilized. Productivity improved. Asset ownership became more central to wealth accumulation. Capital markets deepened. Financialization accelerated. Globalization expanded supply chains and capital mobility. Union membership declined. Labor's bargaining power weakened relative to capital. Growth occurred. Distribution shifted. This is where nuance matters. Friedman argued that markets allocate resources efficiently. He did not argue that markets distribute income equally. Efficiency and equity are different outcomes. That's not moral judgment, it's structural arithmetic. From the 1980s onward, stock market participation expanded, but ownership remained uneven. Corporate profits as a share of GDP increased in several advanced economies. Executive compensation surged relative to median wages. At the same time, inflation remained relatively subdued for decades. Central banks gained credibility. The fear of runaway price spirals faded. Monetary policy became more rule-based, more focused on price stability. Independent central banks became the norm. Controlling inflation became a primary mandate. In that sense, Friedman's influence delivered stability. But stability in prices does not guarantee stability in distribution. Production shifted. Supply chains stretched. Shareholder value became a dominant metric. Markets were not merely tools inside an economic framework. They became the framework. This is where the phrase, "made markets a religion," finds its edge. Not as accusation, but as observation. After the 1980s, the default assumption in much of the Western world was that markets allocate better than governments. When crisis occurred, the response was often to repair markets, not replace them. Even the financial crisis of 2008, triggered by excess leverage, financial innovation, and regulatory blind spots, did not dismantle the market system. Governments intervened massively. Central banks expanded balance sheets by trillions. Interest rates fell to near zero. Liquidity facilities stabilized banks. But the objective was clear: restore market functioning, not abandon it. In the wake of the pandemic in 2020, central bank balance sheets expanded even further. Fiscal stimulus surged. Asset prices climbed. The number of millionaires worldwide rose to historic highs, driven largely by financial and real estate asset appreciation. More wealth existed than ever before. At the same time, wealth concentration widened in many advanced economies. The top segments captured disproportionate gains from asset inflation. Wage growth for many workers lagged behind capital appreciation. Housing affordability deteriorated in major cities. Markets optimized, they did not equalize. Here's the structural distinction. Markets are powerful coordination engines. They process information rapidly. They reward efficiency. They punish misallocation. But they do not contain an internal mechanism for distributing gains broadly, unless the ownership of productive assets is already broad. Self-optimizing means markets drive toward efficiency and scale, even if that scale concentrates power. These are not the same. When competition is vibrant and entry barriers are low, markets diffuse opportunity. When scale advantages dominate and network effects entrench incumbents, markets consolidate. The digital economy intensified this dynamic. Platform companies leveraged scale globally. Marginal costs approached zero for digital goods. Network effects strengthened dominant players. Market capitalization concentrated. The unintended consequence, or perhaps simply the structural consequence, was that market outcomes became more difficult to challenge politically. If markets were assumed optimal allocators, then redistribution required stronger justification. If government was presumed distortionary, intervention became suspect. The burden of proof had shifted. This doesn't mean Friedman caused inequality. It means the intellectual framework that prioritized market allocation reduced the default appetite for corrective intervention. And yet, reality complicates the narrative. When financial crises erupt, markets alone do not absorb the shock. In 2008, governments injected capital into banks. Central banks purchased assets. During the pandemic, fiscal transfers supported households and firms directly. Markets remain dominant, but they are not solitary. Even today, policymakers oscillate between deference to markets and strategic intervention. Industrial policy discussions reemerge. Antitrust scrutiny intensifies. Debates over regulation of technology platforms grow louder. Inflation resurfaces periodically, reminding central banks that discipline still matters. Friedman's framework remains embedded in central banking orthodoxy. Inflation targeting, credibility, and expectations management are foundational, but the political environment surrounding markets has become more contested. In 2026, the world contains more millionaires than ever before. Financial assets have multiplied. Global capital flows remain vast. Did markets succeed in controlling inflation over the long run? Largely, yes. In generating growth and innovation? Undeniably. In distributing gains evenly? Not automatically. Friedman did not argue that markets create fairness. He argued they create efficiency and freedom of choice within a price system. Whether that freedom translates into broad prosperity depends on the surrounding institutions: taxation, competition policy, education systems, asset ownership structures. The modern financial system still operates within the intellectual architecture he helped build. Central banks guard inflation expectations carefully. Fiscal authorities face skepticism about discretionary fine-tuning. Markets remain the default coordination mechanism, but default does not mean divine. Ideas evolve, context shifts, institutions adapt. Milton Friedman did not make markets powerful. Markets were always powerful. He made them the baseline assumption. And when an assumption becomes baseline, it shapes everything that follows, from tax policy to central banking to debates about inequality. Friedman's legacy is not a slogan, it is an operating system. It stabilized inflation, it empowered markets, it constrained governments, it amplified capital mobility, it reshaped the relationship between money and power. Whether that system produces real wealth broadly or concentrates it narrowly depends on forces beyond one man's thesis. But ignoring the architecture would be a financial mistake. Because once an idea becomes doctrine, it stops feeling like an idea at all. It feels like reality. If this gave you a new perspective, hit subscribe. History has the answers.